Inflation remains elevated. That was my biggest takeaway.
Uncle Sam is still spending money like a drunken sailor.
In this video, DiMartino Booth delves into the world of economics and offers her expert analysis on the current state of the U.S. economy. With inflation levels remaining elevated, the Federal Reserve's controlled demolition approach to tackle inflation is causing ripples throughout the financial system. DiMartino Booth sheds light on the potential consequences of this strategy, including more bank failures and tightening lending standards. She also discusses the impact of fiscal spending, commercial real estate, and the need for normalization of monetary policy. Get ready for an in-depth exploration of the economic landscape.
And, even though Jay Powell is cognizant of the fact that monetary policy has started to impair the flow of credit to the U.S. economy, he feels right now that the primary responsibility that he has and members of the Federal Open Market Committee have is to get inflation all the way down to that 2% target. He obviously, he was pointedly asked by one of the reporters, and you played the clip, is September a live meeting? He said it is indeed. We're not necessarily going to slow the pace of rate increases until we have a substantial body of evidence that justifies doing so. Well, to me, if nothing else, that signals that he plans to continue reducing the size of the Federal Reserve's balance sheet. And that's what that tells me. There could be a pause in raising interest rates in the future. I certainly wouldn't think that in 2024 we would see a continuation of rate increases. Even the dot plot from the last meeting told you as much, that Fed policymakers as a group only anticipate one more rate hike, and for that to occur in 2023. But I think when he mentions inflation not coming to target for a very long period of time, what he's saying is this is how higher for longer is going to manifest. We're going to keep rates at a very high level for longer than markets anticipate or certainly are used to, in order to get that inflation down to target, all the while shrinking the balance sheet, continuing to deplete liquidity from the system. I don't think that we have seen the full brunt, the full outcome, the full damage that rate hikes past are going to take on the economy. The New York Federal Reserve put out a survey just a few days ago that indicated that lenders that extend credit for mortgages and auto loans and credit cards, that they foresee going out into the future the highest rejection rates for U.S. households in the history of them doing business. So these are very interesting times that we're in here, because whether you're talking about commercial and industrial loans declining or forced bank mergers, as we saw out west yesterday, there is obviously some damage being done by Federal Reserve policy. And yet, when Jay Powell was asked about restricted lending, tightening lending standards, he basically brushed off the idea. He said that, he previewed Monday's release of the Senior Loan Officer Opinion Survey and said, yes, it's going to show that lending standards have tightened. That's actually the job of monetary policy. It shows that we're being effective in what we're doing. I think that if Jay Powell is trying to shrink the size of the Fed's balance sheet and change the narrative, Michelle, change the narrative away from zero interest rate policy, take quantitative easing away from the Federal Reserve as a future tool. If he's going to do that, he's going to have to maintain a higher for longer policy, regardless of the damage that it might or might not do to the U.S. economy. With the most recent data that we have in hand, we know that the U.S. federal government has just spent $6.7 trillion in the most recent fiscal year. The height of the pandemic, we saw $7.6 trillion being spent. So just $900 billion less. A lot of the money that is being pumped into the U.S. economy is forestalling recession. The Employee Retention Credit, it's an IRS program, is pumping $30 billion a month into the U.S. economy. That money is being spent immediately. We still have massive levels of federal fiscal stimulus that is holding up this economy. And yet at the same time, 93% of the U.S. population is living in a state with rising continuing jobless claims. Last September, that percentage was 0. So
We definitely have a very slow rolling recession that is moving in. It looks like we're going to have Yellow Trucking, a very large company that employs 30,000, go straight to Chapter 7 liquidation as opposed to Chapter 11. That's going to make a few headlines as well. There are pockets of severe weakness, but Uncle Sam is still spending money like a drunken sailor. So it's really difficult to slam the U.S. economy into recession when the U.S. government is still acting as if we're in the midst of the worst days of the public health emergency.
You know, I'm a broken record. I go back to the fact that if you provide American households with $30 billion a month in money to spend, that they're going to spend it. We have Americans at the highest number of Americans since 2010 taking out home equity lines of credit on their homes. Is it 8 or 9% that they're spending in terms of borrowing costs? It is, but they're still pulling money out of the trillions of dollars of home equity that's sitting there. We've got record levels of credit card spending as well. So there are certain aspects of the U.S. economy that remain very much pillars of support. Are they sustainable? Well, we'll see when it comes to the fiscal spending that's going on. I think at some point the level of fraud in this particular program will get some of the more conservative politicians' attention. So the Internal Revenue System, the IRS has already come out and said that they're concerned that these employee retention credits that have gone from about $15 billion a month a year ago all the way up to $33.2 billion for the month of July, that they're concerned that at this juncture, paying businesses to retain employees because of their business was interrupted by COVID might be a system, might be a program that is riddled with fraud. And my answer is, when we were at the very tail end of the subprime mortgage crisis, indeed what we saw were the vast majority of mortgages being underwritten at that juncture were fraudulent. So it's very difficult to when you've got getrefunds.com, innovation taxes, companies one after another selling, soliciting these employee retention credits successfully. They collect 15, 20, 25% of the proceeds. It's very difficult to get a program of this kind under control unless you have Congress come out and cancel it, because it's very, very obvious that we should no longer be spending record levels, $30 billion a month, on businesses that were interrupted due to a pandemic. And yet here we are in July of 2023 talking about just that and seeing international travel absolutely go haywire because so much of the money going into the hands of wealthy American families and businesses, it's going straight overseas. They're shopping on the Champs-Elysees, and we're seeing it in the actual data. So again, Uncle Sam's money at work. When you look at the most recent reading from the Chicago Federal Reserve National Activity Index that came out at the very beginning of this week, it's the broadest gauge of the U.S. economy that we have out there as economists to pull upon. 85 separate indicators that come together in one index. Of those 85 indicators, 56 are contracting right now. So it is very much in large part that the stock market is holding up the confidence level of the U.S. economy right now. 89% of Indeed.com categories of job postings, 89%, Michelle, are negative year over year. We are seeing the demand for labor absolutely collapse. But again, you can create a lot of smoke and mirrors when there's this kind of public fiscal spending going on headed into an election year when nobody really wants to stop that from occurring. After First Republic, the assumption in the investing community was that PacWest would be the next bank to go. Of course, there was a forced merger just yesterday between PacWest and the Bank of California. So what we're seeing is something that is slow moving in nature. But if you're having forced marriages and JP Morgan announcing just a few minutes ago that it's going to be buying $2 billion of mortgages from this brokered deal, we're clearly still in a situation with tightening lending standards. And again, what we're seeing right now in commercial real estate, and that is the next shoe to fall for American banks, what we're seeing right now is a lot of extending and pretending. If it's trash, it's being traded. If it's a trophy, it's being traded. If it's trash, they're simply sending back the keys to the lender. And if it's a very good office property, that's trading as well. But everything in the middle is right now frozen. And you're hearing one bank after another say, we're having to pay up to keep our deposits. And that means continued compression with net interest margins. I doubt that the PacWest forced merger with Bank of California is going to be the last one
that we've seen, but PacWest was indeed that next domino that was going to fall, and it has fallen.
That you're not waking up tomorrow and finding out that the largest junk bond exchange traded fund is no longer accepting redemption requests. We're not seeing a complete collapse in credit in the aggregate right now. What we are seeing is the fastest pace of bankruptcy filings since 2009, but it's one company at a time. And many of these companies are preemptively actually filing for Chapter 11 because they know that they're not going to be able to refinance their debts when the time comes. So as long as it's one company at a time, even if it's as big as $5 billion yellow trucking with 30,000 employees going straight to Chapter 7 liquidation, even if it's that big, as long as there's no contagion, Michelle, we should be fine. And that's what a controlled demolition looks like. If there's contagion, as there was in 2018, when Powell was prompted to pivot, when there were no junk bonds being sold in the United States at all, that's a different scenario. It's clear that Chair Powell has been able to exploit the stock market being high in the sense he's been able to continue on his tightening path. I take my hat off to him. If he's ever going to normalize monetary policy and set up the United States economy to be one that does not have to subsist with zero interest rate policy, then he's going to have to normalize policy. He's going to have to get rates up and keep them up at a certain level. Maybe say 2% is the new floor. But we haven't seen anything disastrous occur just yet. What we are seeing, however, is one company after another in the current earnings season disappoint and guide downwards and say, as Packaging Corporation of America said, the third largest publicly traded packaging corporation in America, they came out and said that their containerboard, their box sales were down 9.8% quarter over quarter, one of the worst that they've ever seen in their history, and that the anticipated recovery in the U.S. Economy that they foresaw occurring in the second quarter has not happened, and that companies continue to destock. But we're seeing this one company after another. We've seen backlogs decline for 14 months in a row in the manufacturing sector. We will see that manifest as a continued rise in continuing jobless claims. Well, I think if the FDIC is busily brokering mergers while we're sleeping, Michelle, that there certainly is that possibility. There's no reason to believe with commercial real estate prices falling as fast as they are and interest rates being as high as they are, that you're going to somehow magically have some immaculate refinancing wave where companies are able to go from the loan that they used to have against the property at 3% all the way up to 9% and somehow survive. It just doesn't work like that. And we know that the regional and the smaller banks are up to their eyeballs in these commercial real estate loans that will have to be refinanced at some point. And that will cause more, hopefully, more mergers that we're seeing as opposed to bank failure that incite contagion.